Hello logical investors, my name is Kevin and welcome back to my channel Logical Investing. In today's video, I'll be teaching you guys a more advanced way people use to earn money in the stock market. When thinking of ways you can earn money through the stock market, most people will know these simpler strategies such as buying the stock or shorting the stock. But when it comes to options, I feel like a lot of people do not know what it is or how it works. Well, there are two types of options, and they are puts and calls. In theory, when you buy a put option for a stock, you would want the stock to drop in price for you to earn money. And if you buy a call option, you would want the stock to go up in price for you to earn money. Buying options is really risky and you can lose all your money from doing it, but selling options is not that risky at all and can provide a steady growth in your portfolio. That is why in this video I'll be teaching you guys how to earn great passive income by selling cash secured puts. In order to sell a cash secured put, first you guys must understand what a put is in theory. A put is a contract where the buyer of the contract is giving the right to the seller of the contract to buy 100 shares at a certain price before the date of expiration. This may seem a little bit confusing, but let me give you guys an example and that may clear up some of the confusion you guys might have right now. So here we have a chart of all the put options available for NEO on my app that I use. There are a lot of numbers in this chart, which might be a bit overwhelming to a beginner, but at the moment you just need to focus on two things. One is the expiration date on top, and the other is the strike price on the side. Currently, NEO is at around $38 per share. Let's say I choose to sell the $37 strike price put option for NEO, and the expiration date is April 23rd. That means if NEO was to go below $37 on April 23rd, the contract will get exercised and the buyer of the contract will be selling me 100 NEO shares at the price of $37 each. Now you may be wondering, why go through all this trouble just to buy 100 shares from a put option when you can just buy those 100 shares normally in the stock market? Well, the catch is that when you sell a put option, you get money for selling it. If we look back at the chart, you can see that the current price for this contract is $1.08. This is the premium you're getting for each share, and each contract is equivalent to 100 shares. Therefore, you're always multiplying the price by 100 to get the total price you're selling the contract for. In other words, if we sell this put contract to someone, we can sell to them for $108 right now. The price of each option is always changing because the price is dependent on the current share price. So the lower the share price is for NEO, the higher the price you can sell these NEO put options for, and vice versa. So let's just say I end up selling this NEO $37 strike price put option, expiration date of April 23rd for $108 premium. So right after I sell the put option, my account will automatically be credited with $108 premium in cash. This cash is mine regardless of whatever happens. Afterwards, there are several scenarios that can play out. Scenario number 1, and also the best case scenario, is by the time it is April 23rd, NEO share price is above $37. Therefore, the put option I sold expires out of the money, and I get to pocket that $108 basically for free. Specifically for a put option, in the money would mean if a share price drops below the strike price of the contract. If we look back at the charts, currently NEO is $38, so all of the contracts that are less than $38 in strike price are currently out of the money, while the contracts $38 and above are currently in the money. The second scenario is that NEO share price goes below $37 on April 23rd and becomes in the money. Therefore, I'm obligated to have to buy 100 shares at the price of $37. This is not necessarily a bad thing, as it all depends on how low NEO stock prices goes down. You need to keep in mind the premium that I got for this trade was $1.08 per share. So essentially my cost basis per share is only $35.92. This means as long as NEO share price is above $35.92, I'm still profiting from this trade. If NEO share prices were to drop a lot, then I would probably lose a lot of money. But that is why you would only sell a cash secured put on stocks that you are already planning to buy or stocks you do not mind holding for the long term. There's also a reason why it's called a cash secured put opposed to just a normal put. A cash secured put means that you have enough funds to purchase those 100 shares if the contract sold ends up in the money. If you look at Tesla put options, they can net you a lot of premium, but I'm pretty sure not that many people can afford to purchase the 100 shares of Tesla, so not anyone can just go around selling cash secured puts on Tesla. If you decide to sell a put where you do not have enough funds to cover for the 100 shares, that would be called selling a naked put. And this is something that is super risky. As a channel that is trying to teach you guys how to logically invest, I will definitely not advise anyone to sell a naked put unless they know what they are doing. Like I mentioned earlier, the price of every contract is always fluctuating depending on what the share price is. So, while the option is still open, there's something that you can do called buy to close. If the share price of the stock you sold a cash secured put on goes up in value, then the contract that you sold will go down in value. That is when you can buy back the exact contract to close and finalize the transaction earlier than the expiration date. So if we use the previous example, let's say we sold that $37 put option for NEO that expires on April 23rd for $108 premium. So currently the share price is at $38. Let's say the share price rapidly increases so it becomes $40 tomorrow. Because the chances of NEO going back down to $37 becomes more unlikely, the price of that option will go down in value. Let's say the option premium goes down to $38. Since we previously sold it for $108, now we can buy it back for $38 to close the contract while earning a profit of $70. When the value of the contract you sold is lower than what you sold it for, buying to close is a way you secure your profits. Now, you may be wondering, how do I choose which put option to sell? First off, you need to choose a stock that you do not mind holding, or better yet, choose a stock that you are already planning to own but currently do not. After deciding which stock you want to sell a put on, that is when you decide what strike price and the expiration date you should be selling this contract for. The strike price you choose, you would always want it to be out of the money, so a strike price below the current share price. Because you obviously want the contract to expire worthless and you would get to keep the premium for free. There is also a number in the chart that you can look at to determine which strike price to buy it for. There is a column called delta in the charts. Delta in a simpler explanation is kind of like the probability of the option expiring in the money. The rule of thumb usually people go with is they choose the strike price with a delta close to negative 0.3. Which implies there is a 30% chance the option will expire in the money. As for expiration date, usually it is always better to choose a closer expiration date because it is more predictable when there is less time left. Further out expiration dates will net you more premium, but the share price of the stock will be a lot less predictable. There's also another column that I want to explain to you guys, and that is the IV column. IV stands for implied volatility, which is the statistic telling you how volatile the price of the stock is. The higher the implied volatility, the higher the premiums will be percentage-wise. So I know this might be a lot of information for you guys to digest, but I think it is always good to learn new techniques in the stock market. That way you'll be able to see more possibilities to earn money and you'll be able to take advantage of more situations you did not see before. Selling cash secured puts has helped me earn a slow but steady income. If you guys like a safer way of earning money in the stock market, this might be the perfect strategy for you guys to adopt as well. If you guys enjoyed this video and learned something new, don't forget to subscribe to my channel and give this video a big like. It will truly help my channel a lot. Anyways, I hope you guys all had a great day and I'll see you guys next time.